But let's move right on then. Tushar Bora is joining in. He's the co-founder and fund manager at MK Ventures to discuss his outlook on the markets as well as what the view is on individual sectors. Thanks so much for taking time out and joining in. And Tushar, clearly financials dominate the overall portfolio. So I just want to understand how you've read into the kind of quarterly earnings and whether or not you believe that banks will see a steady run in Q4.
Yeah, thanks for the opportunity. Good to be back on ET now. I think financials have started on a very strong note. The earnings reported so far across banks and BFCs, in general, there's a very positive read-through. Financials looks very attractive. Say next couple of quarter earnings momentum looks to be very strong. However, we have to also be cognizant that we are clearly in terms of the cycle, the credit cycle it's on a very strong note right now. But I expect that over a period of time there will be some moderation here, and once the trade cycle cools off after peaking, whether the prices would continue to run up is what to look at. However, on the whole, I think earnings looks good. Banks clearly is an area to continue to remain invested, and you'll get a lot of opportunities to shift between banks. So I'm positive on financials overall as a pocket.
When you say shift in between banks, what are you referring to?
No, I mean, so let's take for an example the large cap side, right? HDFC Bank, and Kotak have not really performed last 3 years, and some of the other banks have done much better on a relative basis. So I believe that there would be shifts between the between banks from some of these ones who have performed in the last couple of years, where the prices have run up, to some of these larger banks like HDFC and Kotak maybe, which have not yet done that well, say in the post-COVID period.
Typically, when you go through a cycle like this, everyone should participate. But right now, there is a fight for liabilities. Not everybody is getting a strong share of liability. Big banks are getting it. Some PSU banks are getting it. So is that one should focus on? Anybody who's getting liability or fixed deposit, those are the banks which will do well?
Yeah, so banks which have a strong liability franchise will continue to do well. Even NBFCs for that matter, selectively we should be looking at, because since the start of the rate hike cycle, in general, NBFCs have not done that well. And there are pockets of opportunity in NBFCs also. But yes, large banks with strong liability franchise will continue to get their more than their fair share of business as well as do well in markets going forward.
If let's say financials have a 35% weightage in benchmark indices, should one stick to 35% weightage, or it's time to bring it down to underweight?
No, I would not go underweight on financials, not yet. See, if the Nifty has to move to a new high, financials have to play a very important role. So I would certainly look at financials to continue to lead the direction, the positive side. So I wouldn't go underweight on financials. I would just say that, in fact, across sectors, I think it's more important to be very choosy and selective, discerning in what you are owning, rather than to try and take a overall sectoral call. So I would continue to be bullish on financials. Just look more closely as to what I'm owning at a given point in time for next few months.
Tushar, what's the outlook when it comes to the entire consumption space as a whole? Do you believe that in times of this sort of choppiness in the markets, one can cushion the volatility with a decent enough exposure to some of these defensive sectors like FMCG or even pharma for that matter?
So FMCG, I think the earnings reported so far have been good. Pharma is still early. A lot of earnings are yet to come. But I think definitely it's time to shift focus, especially pharma, which I track very closely. I think there is a lot of momentum still left. In fact, pharma we've seen last 1 year in a number of stocks, on compressed earnings because of various issues. Let's say raw material prices were much higher, oil prices in general were higher. That affected them on multiple points on the P&L. I think we are clearly moving out of that phase. The sector looks set for a fresh momentum. It's very early stage, but I like pharma as a pocket at this point. FMCG, I'll be more selective. I think while earnings look good so far, whatever has been reported, but the valuations, still are much higher than comfort for a number of these stocks. So I'd be more selective in FMCG. I'd be more willing to go, say, aggressive in pharma at this point. And especially in pharma on the small and mid cap side, a lot of these stocks which are not very widely tracked and are attractive at say high single digit or very low double digit PE multiples could really prove to be a very good opportunity for the next 12 to 15 months perspective.
Pharma space for us. I mean, 2020-21, if you had a COVID portfolio, hit a home run. If you're in the API business, names like Loris, DVs, they did very well. What within pharma? Domestic MNC, API, non-API, generic, non-generic. What do you like there?
I think so. If you see US, the larger pharma companies have started to now report better earnings. The commentary has improved. On the large cap side, Sun has really reported very good earnings last 4 or 5 quarters on an overall basis. I think it's time to start looking at these companies more closely. But I continue to prefer, on the whole, the API and CRAMS space. CRAMS said, while I don't comment specifically, but since you've asked DVs and Loris, I think probably the next few quarters would continue to remain challenging because clearly some of the COVID-led opportunities, need to be filled up with regular business. But I maintain a very long-term bullish stance on the CRAM side. And on API side, Nikunj, across the board, the valuations have compressed to, high single digit, maybe 10, 11 times PE on FY24 earnings in a lot of cases. This is a classic case of depressed times and depressed earnings depressed multiples coming together. So API, I think from a percentage point of view, you'll see very, very strong returns next couple of years. But for a lot of these institutions, the API names may be much smaller in size, and so they will continue to prefer large cap names. So I believe the domestic business, in fact, in that context, Mankind IPO closes today. I wouldn't be surprised if it sees a very, very strong institutional participation in main book and beyond listing. It continues to do very well. So I am bullish on the overall space. US generics, I think, has also bottomed out as an opportunity. Some very good companies available here. But within that, preference would be on API and CRAMS going forward also.
Where are you ready to bet on a new cycle? I mean, let's say if you bought banks a year ago, you bought the beginning of a cycle. If you bought IT in 2020 at the peak of COVID crisis, you bought the beginning of a new cloud adaptation cycle. Defense, new cycle started in 2021. Where are these new cycles starting?
So I think these cycles have started, like you mentioned, defense, capital goods, manufacturing-led themes. These cycles have started railways. We've done one round where everything has gone up. I think we will see another cycle in IT over the next 6 months. A lot of IT mid caps have not done that badly on results. If, for example, ER&D companies, results have actually been much better. So only the large cap side, the frontline stocks have done much worse in terms of earnings. But IT, I would bet that we will see a bottoming out in the next 1, maybe 2 quarters and a start of a fresh new cycle. Pharma, I am bullish that a new cycle has just started. Infrastructure, I think, we are in the midst of a cycle right now. The valuations are still quite attractive for a lot of the infrastructure players. We are clearly in a seasonally strong execution quarter, Q4 earnings that would get reported. I believe we'll see good traction across the board. And next 1 year, infrastructure should be a good space to own. So, and also it's not that, something like defense or manufacturing, it's not that the opportunities are gone. We've just seen the first round, when typically it's the hype phase when everything moves up and then everything will come down systematically. And the second round of the cycle will start in defense and manufacturing and capital goods and engineering stocks, where you will have to be more selective. It will be a bottom-up led cycle. The specific companies will really outperform the entire space. And if you get your bets right, there's a lot of money to be made next 3 years, 5 years in these sectors also. Autos being another one. Within autos, I prefer OEMs at this point because clearly ancillary companies have relatively outperformed and valuations are also much higher in a lot of cases. So OEM as a pack, I think it's time to look at that and selectively on ancillary side as well.
ATM, do you think the tide is turning for them? Because that's the most talked about view. I mean, half the world is divided that they will never make money. Half the world is divided that they will make a lot of money in 3 years.
Which sector I missed?
No, the entire fintech consumer tech space, whether it is Zomato or Paytm, The businesses are different, Tushar, but we always tend to classify them as one.
Fair enough. Nikunj, I have generally been bearish on fintech and consumer tech spending. As a personal preference, I don't like businesses which lose money today in the hope of making it sometime in the long distant future. But so selectively, there are some franchises which are very, very strong. So, for example, logistics as a pocket, I think some of these companies are doing really good work. Even fintech, clearly at the time of IPO, there was a lot of hype and obscene valuations. Now, the businesses are starting to catch up and commentary started to become more moderate. So, be it Zomato, be it Paytm, there's no longer an air of, frenzy around these names, which is a perfect environment to actually dig deeper into the space. And as a house, we have, looked at these opportunities much more closely in the last, 3 to 5 months than we did at the time of IPO. And we think there are some very good opportunities definitely available, both fintech and consumer tech side, consumer related stocks. Just that, it's not necessarily a time to act, across the board. It's a time to continue to do your work and selectively you'll get the times to buy and you make the best of them.
I also wanted your take regarding the IP of Mankind Pharma. We have seen decent amount of subscription so far. What's your recommendation on that?
So without getting into the merits of fundamentals of Mankind or any specific company related points, I would like to highlight a couple of points. I think people prefer simplicity of execution. It's a simple business. You have to only track execution. In case of domestic pharma, even the execution tracking is very, very systematic. You have a monthly readout of how each segment is doing. Even at a product level, you get data on a monthly level. So domestic pharma is a much easier beast to track. People like it because there's a certainty of earnings. There is less volatility, less regulatory volatility, or price erosion. These kind of things are much lesser with domestic pharma. Within that, I would give credit. Mankind has built a very, very strong consumer franchise over the last 15 years. Coming into a crowded field already, they've done really well. And I think they have a very good chance to stand out even as a stock. Just to give a data point, there's about, say, 1.3 lakh crores of mutual fund investments in pharma, give or take 10,000 crores. Of that 1.3 lakh crore, I believe more than 75, 80,000 crores is invested in the top 5 or 6 names across healthcare, diagnostics, hospitals, all three. And of that 80,000 crore, my bet would be that, from the time the cycle peaked originally in 2015-16, most of these investments have actually not made any money. Some of them would have probably made a double-digit negative CAGR in the last 8-9 years. So there is definitely a vacuum at the top. People are looking for large-cap quality pharma stocks, which are easy to track, simple and execution-focused, and where you have peace of mind. Then you can typically deploy a large amount. I think Mankind fits well in that category. I wouldn't be surprised if it has a good listing, but more than that, if it continues to deliver very strong returns post-listing.
Your time. Thanks so much for giving us a deeper insight as to what the strategy is, your outlook on individual sectors and the markets as a whole.